This is Al Brooks, and this is my price action trading course. This module has to do with trading weak bear channels. Is a channel weak or strong? Take a look at the module on channels. So if you have a bear channel, is it weak or is it strong? Sometimes it's impossible to tell, but it doesn't really matter, because if there's any question, assume that it's strong and only look to sell. Bear implies trend, lower highs, lower lows. Channel implies weak trend, in contrast to the breakout phase, a strong trend. Sometimes weak trends can be very strong, but I use the term synonymous with channel and in contrast to spike or the breakout phase. The weaker a channel is, the more likely trades in both directions will be profitable. When it's weak, it'll have broad swings, lots of two-sided trading. If it's reasonably strong and the bounces up are not very big, it's better only to trade in the direction of the trend. In other words, sell. Sometimes it's impossible to tell whether the market is in a broad channel, a broad bear channel in this case, or a trading range. And very often it's in both. But it doesn't matter whether or not you know that is a channel or a trading range. You trade them the same. You buy low, you sell high, and you scalp. In fact, most weak channels, up or down, begin as trading ranges. So what are the components of a weak channel, a weak bear channel? You have overlapping bars. You have weak follow-through after bear bars. So you'll have a bear trend bar and then maybe a bull bar. Many bars will have tails on the bottom, meaning that there was buying into the close of the bar. And you'll also have a lot of bars with bull bodies. So you'll go down and then a bull body up, maybe two bull bars up. The pullbacks will be obvious, some of them lasting many bars, and it essentially looks like a trading range that's tilted down. Take a look at what we have here, all right? Clearly a trading range, right? But look at what's happening. We have a high, lower high, lower high, lower high, low, lower low. So yes, it's a trading range because we're mostly sideways, but it's also a bear channel because we're forming lower highs and lower lows. And by definition, that's a bear trend. It's not a bear spike, and therefore it has to be a channel. It's weak because there are a lot of bull bars within it, many reversals, and prominent tails on the bottoms of the bars. Traders can look at this and say, yeah, bear breakout, two big bear bars, but three pushes down and it's becoming parabolic. It's accelerating downward, and it could simply be a parabolic wedge or a failed breakout below this double bottom. However, this bull bar has a tail on top, so it's not a strong bull bar, and its body is small compared to these two bear bars. So this bull bar is not sufficiently strong to reverse these two bear bars. So I would not be looking to buy. I would assume that we're still in a bear channel and we're still forming lower highs and lower lows. Alright, well here the buy never triggered. Now we have another push down, and maybe we're forming a parabolic wedge. Three pushes down, becoming increasingly sloped, and we have a second attempt to reverse up. We have this bull bar, and now we have another bull body. So you can argue it's a second signal. The first never triggered. To me, I would not buy that. This small bull body is not enough to overcome all this bearishness. Yes, it could end up being a failed breakout of the double bottom. It could end up being a higher low after this low. We're forming higher lows and higher highs. So it could be part of a larger bull channel. But to me, this is not a strong enough buy signal. Okay, I think this is interesting. And this is very common in the early stages of a channel when you're deciding whether it's still a trading range or it has become a channel. All right, very strong bull bar, follow through bull body, and then another strong bull bar. However, we're still below the most recent higher low or lower high. All right, so if you're a bear, you can take a bet that the market will continue to form lower highs and lower lows. You could sell this strong bull close, saying yeah, it's strong, but it might be a sell vacuum test of the top of the channel. I'll sell the close with a stop above the most recent lower high. So my risk is from this point to this point, and if I'm right and it is a bear channel, I'll get a new low, and my reward is several times bigger than my risk. So it's a reasonable short. As far as the top of the channel goes, you can draw it across these highs, and we're not quite there. And you can also do a best fit type of channel. Channels are rarely perfect. However, even though we're not at the top of the most obvious channel, we're pretty close to it, and this could be the top. Bears who did not want to sell the close of a pretty strong bull spike might be willing to sell below a second bear bar. So we have, below a 2-bar reversal. We have an up bar and a down bar. By the way, this is a weekly Forex chart, the euro versus the dollar. And these bars are very big. Each bar is about 500 ticks tall. So you can bet that the bear channel will continue to form lower highs and lower lows. And you could sell below the low of this bear bar and put a stop just above its high. So if you sold on a stop 1 tick below the low of that strong bear bar, you'd be filled right here. And you'd probably put a stop above the high of this very big bear bar. Risk 564 ticks. When you look at this, you don't say, oh yeah, this is probably going down. You look at it and say, I don't know, maybe it'll go down, maybe we're trying to form a higher low major trend reversal, maybe we'll go up. Okay? So you're uncertain. That means you need a reward at least twice as big as your risk. So when you take this trade, your initial risk is above this bear bar, so 2 times that initial risk is down here. So this would be your target if you took that short. Or at least it would be your initial target. Okay, good bar for the bears, right? You entered right here, and now you have a strong bear close. You might tighten your stop to just above the high of this bar. You could put it above the high of this bear bar. I probably would put it above the high of my entry bar. So at this point, we have a strong bear bar, and you're not going to let it come up again. So at this point, you can calculate your actual risk. Okay, you shorted 1 tick below this bar, so you're short here. And at this point, your actual risk is 1 tick above the high of this bar. So if your initial stop was 1 tick above the high of this bar, you would not have been stopped out, and you'd still be short. So your actual risk is from your entry price to 1 tick above the high of the entry bar, 252 ticks. You can adjust your reward. So instead of basing it on your initial risk and putting a target down here, you could base it upon your actual risk, and 2 times your actual risk is right here. And you could try to get out right here. And this is, I think, a more realistic objective. So you would have had a limit order to buy back half or all of your position at 2 times your actual risk, and you would have exited as the market fell below your limit order. The market continued to fall, and then we have a 2-bar reversal, a bull bar and a bear bar. It does not matter that there's a bar in between. On some higher time frame chart, these 2 bars will probably form a reversal bar. All right, I don't have a trend channel line drawn in here across these lows, but this would be pretty close to the low of the channel. You can argue micro wedge, 3 pushes down, 1, 2, 3, and a larger wedge, bottom of the channel. If you're aggressive, I think you can buy above this 2-bar reversal, above this strong bull bar, betting that we'll get up to the top of the channel. I think the probability is not high, so if you are to take this trade, it's not a high probability trade. You have to be going for a reward that's 2 times your risk, which would be up here. Could be a final flag. This II pattern could be a final flag, so this could be a final flag reversal. This is 12 bars down without a pullback. Every bar has a high up below the low of the prior bar. In general, if you have a big micro channel and a bear trend, it's usually better not to take the first reversal up. So I think this is a pretty aggressive long. By the time this bar closed, however, it looks pretty good for the bulls. The follow-through, not very good at all. Two little pushes down, so a little micro double bottom. And we're at, you'd also, after the strong bull bar, you can adjust your protective stop from below the signal bar. So you can move it from your initial risk to your actual risk. And had you bought above the high of this bar, or above the high of this bar, your actual risk would be to one tick below the low of that bar. 2 times your actual risk would be here. So even if the trade is less than 60% certain, right, you can still exit at 2 times your actual risk, and you would have been filled with your limit order as this bull bar went up there. Look what happened on the next bar. I don't have the top of the channel drawn in, but we're probably pretty close to the top of the channel. We have 2 legs up, a strong 2-bar bull spike here, and now we have a strong 2-bar reversal up and down. On a higher time frame chart, that could be a single reversal bar. 3 small dojis, so forming a tight trading range. Most tight trading range breakouts fail, so we're breaking out and we're failing. You can argue this is a low too short. Here's the first push up, here's the second, here's the first, here's the low 1 trigger, and then if we fall below that bear bar, that would be the low 2 trigger. I think this is probably an okay swing short for a test in the area of the top of the channel. This is so strong, we may go sideways in here some. Big down, big up, usually big confusion, and that means sideways. So I also think it's okay to wait for a second signal, especially with these 3 strong bull bars. Alright, let's say the pink line, you draw a channel across these 2 highs, you get this pink line. We're not quite up to the channel line. You could draw it as a parallel from a best fit line. You could use this low and this low, or you can use that low and this low, and create a parallel, and that's that blue line. If you do that, we are poking slightly above it and reversing down. Channels are rarely perfect, and there are usually multiple choices for the possible lines. In general, you look to short a reversal down from the top of the channel. This is so climactic, I suspect that we probably have more sideways to up. And this is an okay short, but it's also okay to wait to see if we get a second signal. Alright, it would have triggered here, not a very big entry bar, and we're back into this 3-bar tight trading range, so we may end up going more sideways. If you did short below the low of this bar, your stop is still above the high of that strong bear bar. If we get a strong bear bar, another strong bear bar, we can lower the stop to just above its high. And instead we get a bull reversal bar, a possible double bottom, not really a high or low major trend reversal, not enough bars down here. To me it looks like we're still sideways. We got a strong bear bar at this point, so if you're still short from here and you did not exit above this double bottom, at this point, a strong bear bar, you could lower your stop to above its high. So at this point, you can calculate your actual risk. You get in on this bar, 1 tick below that bear bar. The market has turned down, and now your stop is 1 tick above the high of this bar, and your actual risk is 201 ticks. Since it's not certain that the trade will work, in other words, the probability is low, you have to be going for a reward that is 2 times your actual risk, and that would be down here at this red line. Alright, another problem for the bulls, a triangle, 3 pushes down, 1. Problem for the bears, 3 pushes down, 1, 2, and 3. The bulls can argue it's a bull triangle, and we'll get a bigger second leg up, and we might. I personally would not take the long. We're continuing to fail at the moving average, and until we break strongly above the moving average, I'd rather assume that we'll fail some more. So the traders who shorted below this bear bar, their stop is above here. Once we fell below here, they probably would tighten their stop to below this bear bar. If traders did not short this bear bar, they could short below this bear bar, for a triangle. 3 pushes up, 1, 2, 3, and it's a triangle at the moving average with a close below the moving average right on the low tick. Had you shorted here, you would have been filled at 2 times your initial risk as this bar fell below your profit-taking limit order. Alternatively, had you not shorted here and you waited for the triangle short, you would have been filled on the open of this bar as the market gapped below that bar. This is probably a more conservative entry, a triangle and a bear rather than shorting the 2-bar reversal after a pretty strong bull spike. So if you took this short, your initial protective stop is above the high of the signal bar. Your entry is here on the open, so you're risking 200 ticks. The risk is fairly small for a weekly chart, so it's okay not to put your target in. You could go for a reward 2 times your risk. I certainly would not go for a reward only 1 time my risk because the setup is so strong. So what you could do is you could exit 2 times the risk, or you could hold off and wait for some evidence that the leg down is ending and then exit. The market quickly fell with a series of bear bars, a 2-bar reversal but a big tail on top, and a 5-bar bear microchannel. I personally would not buy that. The bulls were able to rally after whatever this is, a 10-bar bear microchannel at this point. This is a possible higher low major trend reversal. We have a bear trend here, a trend line, a break above it, test of the moving average. It's possible that this is a major trend reversal, but 5 bars down and a bull bar with a big tail on top, that's not strong enough. This bar is not strong enough to reverse those 5 bars. And if I were swinging part of my position, I would hold that part short. At this point, my stop would probably be above the high of this entry bar. Whenever you're in a trade, you have to be looking for reasons to take profits. You could exit above this 2-bar reversal. I think it would be okay. I probably would wait for some kind of a second signal. We have 2 pushes up, bull bar, bear bar, bull bar. So this is effectively a low 2 short, and a low 2 short late in a bear trend often becomes the final flag of the bear trend, and a reversal often follows. So you could exit up here. I probably would take profits here. We have an outside bar, strong bull bar. I could see and a possible final flag reversal. So to me, it would make more sense to exit above the high of that bull reversal bar. Okay, weak bear channel. It's a bear trend. So even though there are tradable swings in both directions, and it behaves like a trading range that's tilted down, you want to buy low, sell high, and scalp like in a trading range. You want to sell at resistance and take profits, or even buy at new lows and support. But in general, I want to make sure that I sell. If it's a bear channel, it's a trend, I want to make sure that I take the sells. I don't worry as much about taking the buys at the bottom of the channel, and I only take them if the setup looks especially strong. Protective stops, it's better to scalp most trades like in a trading range. Scalping, I talked a lot about exiting at 2 times the risk, and that to me is a swing and not a scalp. It's borderline. To me, as soon as you start going for a profit that's more than 2 times your risk, I think it's a swing. If you're going 2 times your risk, you can call it a swing or a scalp. In this kind of a setting, since you're not allowing the profits to run, I think of it as a scalp. In general, if you're scalping, you don't want to allow pullbacks, and you get out of your shorts above any strong bull bar and any strong bear bar, because remember, you're tightening your stops. Every time you get a new strong bear bar, you're moving your stop down to above its high. So if the market goes above the high of one of those strong bear bars, it's probably better to exit. Initial stop when you do short is above the high of the signal bar. Okay, so arguably a low 2 final flag. If you draw a trend channel line along the bottom, it's a possible wedge bottom. You can argue it's also a lower low major trend reversal. We have a bear trend line that I did not draw, a trend line break, a test of the moving average. a triangle, which is often a final flag, and the market usually comes back and gets at least back to the middle of the triangle. So, I definitely would get out of shorts as far as, going long. If I were flat, I would go long. If I were short, I might reverse. It depends on how I feel. In general, I don't like to reverse. I prefer to get out and wait a few bars before looking in the opposite direction. This is a weekly chart, so I'd have plenty of time to reverse if I wanted to. I could reverse during any one of these bars. This, by the way, this outside bar is an outside bar. This is an outside bar, a little bit bigger than that bar, and here's another one. So it's a micro double bottom. The market went down and up, and then down on these two bars, and then up again. So if you took the conservative entry on the triangle breakout, your profits would be, and you only took the shorts, your profits would be 894 ticks. Remember, this is a weekly chart, so the bars are very big. If you were much more aggressive and you took the earlier entry, well, actually, right here, I'm not showing the earlier short. I'm still showing this, but I'm also showing the buy right here. You would have more profit, 1,300 ticks in profit. Okay, a broad bear channel. Although that particular channel had many features of a weak bear, there really was very little opportunity to buy. And when there's any doubt about whether or not you should buy, I would treat the channel like a strong channel and make sure to take all the shorts and only buy if there was a very strong buy signal. Here's another example, this time using the weekly spider chart. And there's an expanding triangle top, a high, a higher high, and another higher high. To me, this is a weak sell signal. I mean, you could argue an expanding triangle is a major trend reversal, and it is. So technically that's a short, but I think it's really not a strong short. The context is okay for a short. The signal bar is not very strong. Had you shorted below that bar, you'd look at your actual risk, which was 1 tick above the high of this bear bar, and you try to get out at 2 times your risk. The probability is not high, so you want to take a reward 2 times your risk. So you probably would have been filled at this bar, and probably a lot of traders did that same thing, 2 times their risk, and that's what created this bear bar. This big bull reversal bar. All right, so now we have a second attempt down. So this is a pullback from this bear breakout, and I think it's an okay swing short. We're in a trading range, but we have an expanding triangle top, which is always a higher high major trend reversal. So we may get a second leg down. Chances are we will. Since this is a pullback from this very strong breakout, and we now have evidence that the bears are strong, I do think that is an okay short. Expanding triangle tops usually test down to the bottom of the expanding triangle. Right now, we're still in a trading range, but we also have an expanding triangle top operating. So what's going on at this point? Okay, so if you took that short, you'd probably take some profits, certainly on this reversal up. What about buying? We have a double bottom. We have 2 small legs down. Very strong 2 bull bars. I probably would wait for a breakout pullback buy, like maybe above this bar. But with the expanding triangle top, you can call it a double top, expanding triangle top. You can call it a higher high major trend reversal, or you can call it a double top major trend reversal. You could make the bear case. We don't yet have lower lows, but we are starting to get small lower highs. So I do think you can short this as a double top bear flag, and on the premise that the market will have more down. So I do think this is an okay swing short. I don't think it's a good scalp. We've got too many bars up, and we're still in a trading range. So look what happened. So let's say you took this short below this bear bar, and you put your stop above the high of the bar for your initial risk, and then the market started to turn down on this bar. As it's turning down and this bar is forming, you'd look at it and say, my actual risk was 1 tick above the high of this bear bar, and therefore you can try to get out at 2 times your actual risk. You could place a limit order here at 2 times your actual risk, and you'd be filled there. You could either take all profits or partial profits. At this point, we're at the bottom of a trading range, right? So you can only hold short here if you're betting on a swing. But it's okay, I think, to take total profits. Okay, this is what followed. More bear breakout. Now a possible double bottom. The bulls can argue 2 legs down, 1 and 2, and then a double bottom, and a rally. Those swing bears who are still short, they probably have their stops at break even, certainly above this bar, certainly above that lower high. Now the bears, if they want to press their shorts, betting that this is really just the first leg down of 2 legs, okay, and that this is just a 2-legged correction, a large low 2 with a very strong outside down bar. Let's say they were aggressive, they could take this short. They could short below that bear bar and bet that maybe we'll get a leg 1, leg 2 move down. Here's leg 1, and then maybe we'll get leg 2 down. Low probability. Look at all this buying pressure in here, all these very big bull bars. So low probability, so you have to go for a reward that is at least 2 times your risk. Okay, the first leg down is mostly in a channel. Yes, a very broad channel, but it might be the first of 2 larger legs down. Again, with all this buying pressure in here, I think it's a low probability short, but it's okay to take it if you're going for a target at least 2 times your risk. And this is that entry, and this is what that entry, and this is what followed. The market just absolutely collapsed. A triangle in here, 3 pushes up, 1, 2, 3, possible final flag, strong bear breakout, probably consecutive sell climaxes, very climactic behavior all the way down, probably unsustainable, and now we have a potential final flag, and we have a 2-bar reversal, either this bear bar or that bear bar. I think it's probably good to take profits on shorts at this point. After consecutive sell climaxes and a potential final flag and a lower low major trend reversal, the odds are that the market will have at least 10 bars and 2 legs up. Okay, a broad bear channel. The broader the swings, the weaker the channel, the more it behaves like a trading range, and you can trade it like a trading range. You can buy low, you can sell high, and scalp. Okay, here's an example of a very broad bear channel. Lower highs, lower lows, but also a trading range. Most channels begin as trading ranges, and while they're still trading ranges, you usually can trade in both directions. So in this, when the market looks like this, I think you can look to buy low, sell high, and scalp. So when the market reverses up from a new low, I think you can short. When it gets near the prior high, you can sell. Here's what I'm talking about. You're selling right below prior highs, and you're buying anywhere near the bottom of the trading range. Even though ultimately this may become a very strong bear channel. At the moment, it's a bear channel, but it's also a trading range. This is just one other channel that I'm mentioning, shrinking stairs. It's actually a fairly strong bear channel. It's fairly tight. However, I'm only mentioning it because of the scalp opportunity that it offers for experienced traders. Okay, this pink box is from the most recent low to this low. We pulled back. This pink box is the size of the next breakout, and then we rallied. So traders see that this pink box is smaller than this one. So this breakout is smaller than the prior breakout. So each step down is becoming smaller, and experienced traders will use that for a scalp. They'll expect this breakout to be smaller than this one, so they will place a limit order to go long at less than the height of this box, and they'll look for a scalp up at least to the bottom of the prior breakout, and probably up to the moving average. Obviously a bear trend, so obviously you take the shorts, but you can fade the breakouts, betting that the next breakout will be slightly less than the prior, because that's what's happening over here. And that's the end of my module on trading weak bear channels. This is Al Brooks, and this is my price action trading course. This module has to do with trading channel reversals. Many reversals begin with a breakout of a channel that fails and reverses. The market then usually tests the opposite side of a channel. And once it gets to the opposite side of the channel, it either breaks out beyond the channel and begins an opposite trend, or it reverses again and the channel just continues to grow. There are many kinds of channels. Anytime the market is contained between two lines, it's in a channel. For example, a wedge is a channel, a triangle is a channel, a trading range is a channel. This particular module will be discussing mostly channels that have approximately parallel lines. You can see the module on channels and the other modules on wedges, triangles, and climaxes. When the market's in a channel, you really only need to see one of the two lines. You either need to see the trend line or the trend channel line to know that it's in a channel. The market is in a channel if you see one line, even if it does not look conventional, and there's always an opposite line even if you don't see it, or even if it doesn't look right. Here's an example. We have a clear trend channel line along the lows, so you have to assume that the market is in a channel, even if there's no obvious upper line. The market poked below the bottom of the channel and then had a bull reversal bar, so it might be trying to reverse up. You can see that it rallied on the right hand side of the chart. This high is an obvious point to use to construct an upper channel, but when you do, it's not parallel, so that doesn't look as conventional as you would like it to look. You could do a best fit channel across this high, or you could do a parallel from this trend channel line and drag it up and anchor it to this high if you want to have a parallel channel. Otherwise, you can just draw this line, even though it looks like an unlikely top of the channel, and then trust it until the market proves that it's not paying any attention to that upper line. When you extend this line out, you can see that the market, after it broke below the bottom of the channel and reversed up, it eventually worked its way up to the top of the channel. The channel created by these 2 points, even though it's not parallel with the lower channel. So why pay any attention to channels? It's because they offer opportunities. When the market tests the top or bottom of a channel, it either breaks out and then goes for some kind of measured move, or it reverses and goes to the opposite side of the channel. And in both instances, the reward can be much greater than the risk. And since the probability is never below 40%, you have a very good trader's equation. The market is always in a cycle. It's either in a trend or a trading range. And once it's in a trading range, it then eventually breaks out into another trend. A trend, there are two types. It starts with the breakout phase, and then the trend becomes more two-sided, and it enters a channel. And the channel eventually weakens to the point that it becomes a trading range. Okay? As part of the market cycle, channels usually weaken and become flatter, and then the market enters a trading range. A channel is a hybrid between a spike, a breakout, a strong trend, and a trading range, and it's a transition between the breakout phase of the market cycle and the trading range phase of the market cycle. Every bull channel is the same as a bear flag because most bull channels have bear breakouts, and they should be thought of as bear flags. Every bear channel should be thought of as a bull flag. Most of them have bull breakouts. So here we have a very strong bull trend and a very tight channel. And if you only look at this point and to the left, you'll say, wow, what a strong bull trend. On the other hand, the channel usually becomes part of a trading range. And if you look at the entire chart and you say, well, where did the trading range begin? You probably would say, well, it began over here. But that's also the start of the channel. Remember, channels usually evolve into trading ranges. Even the strongest channels usually evolve into trading ranges. A bull channel, it functions like a bear flag, so chances are it'll have a breakout through the downside, exactly like a bear flag. Here's a strong bear channel. It's fairly tight, very strong bear trend, right? But every bear channel should be thought of as a bull flag, and the odds are it'll have a bull breakout, and then it will transition into a trading range. And that's what the market did here. We have a bear channel, a bull breakout, and then the market transitioned to a trading range, even though at this point it did not get to the top of the channel. Most channels end with a failed breakout. So here we have a bull channel, and you draw the trend channel line along the top, and the market broke out of the top, but it did not close up there. The close pulled back, and that tail represents a failed breakout. Remember, every tail is a failed breakout, even if you don't see what's being broke out. Once the market reverses back into the channel, it usually tests the bottom of the channel, and then eventually the channel evolves into a trading range. The minimum target when the market reverses back into the channel is one tick below the bottom of the channel. That's not the maximum target, that's the minimum. And eventually the channel becomes increasingly two-sided, and the market turns into a trading range. Here's that bear channel that I showed earlier. We broke below the bottom, and then a tail, a failed breakout, a bull signal bar, and we rallied up to the top of the channel. The minimum target was one tick above the top of the channel. The market ran up so strongly that it broke out and went quite a bit above the top of the channel. It does not have to stop here. It can break out. Fade channel breakouts. Okay, that means look for a trade in the opposite direction. All right, so you look for tests at the top and the bottom of the channel. You look for a breakout that fails, and then when there's a reversal, you enter on the reversal with the objective of the market testing the opposite side of the channel. It doesn't matter if it's a bull channel or a bear channel, or it doesn't matter if it's the top or the bottom of the channel. Here's a wedge. A wedge is a type of a channel. We have a bull breakout, and we went down, and then we went up again, and we're going down again. So we have a micro double top, and we have a bear signal bar. So that would be a reasonable short. You'd go short at one tick below the bear signal bar, and your initial stop would be one tick above the top of the signal bar. After you have a strong bear bar like this, opening on its high tick, closing near its low, you can tighten the stop to one tick above its high and calculate the actual risk. So your entry price is here, one tick below the signal bar, and your actual risk at this moment is one tick above the entry bar, and 2 times the risk is down to this red line. So since you're shorting in a bull trend, the probability is not all that high, especially with all of this buying pressure. You need to go for a reward that is twice your risk to compensate the relatively low probability. So you might exit all or half with a limit order at 2 times your actual risk. With luck, the market may trade all the way down to the bottom of the channel. Another big bear bar, so you'd probably tighten the stop to one tick above its high, which would be around break even. Remember that channels tend to evolve into trading ranges. We have a high 2 buy and a bull trend, and it's a possible final flag. A magnet, the market usually comes back to it, and here we broke below it and we're trying to reverse up. So this could be the start of a trading range. It's also a high 4 buy. There's a high 1, a high 2, high 3, high 4. 4 pushes down, and channels often end with high 4s. So this is a reasonable location for taking final profits. A high 4, possible failed breakout below this bear flag. Okay, so what's going on here? All right, we have a bear channel. The bottom of it is a trend line. We have a break below the trend line, and now we have a rally testing the bull high. So this is a double top major trend reversal, a double top over here, and it's also a low 4 short. 1, 2, 3, 4. Channels often end with low 4s, and this is a channel. And we have a decent sell signal bar, bear bar closing on its low. So we should get a second leg down from this wedge, and that is a reasonable short for a swing down. And you can see what happened. We got a good entry bar, decent follow through. 4 bars down, so probably sellers above. I would not buy above that bull bar after these 4 bear bars. And then the market collapsed. Sometimes the market does not quite reach the line and it reverses before the line. Okay, so sometimes it gets close to the line but doesn't quite touch it, and then it reverses. If the context is supportive of a reversal and the signal bar is strong, you can take the reversal trade. If it's not, wait for clarity. Okay, so here we have a channel. It's a triangle, 3 pushes down, 1, 2, 3, and the market has a doji inside bar here, a high 2 buy. There's a high 1, high 2, and it's trying to reverse, but it's not quite down to the bottom of the channel, down to the trend line. So should you buy that, or should you wait to see if we get down a little further? Okay, a triangle, but we're getting higher lows, right? So it's a trading range, but it's also a bull trend. Why is it a bull trend? Because it's getting a series of higher lows. Here's a low, higher low, higher low, higher low, possible higher low, right? So it's a trading range and a triangle type of trading range, but it could also be a bull trend forming a series of higher lows and ultimately breaking out to the upside. So is it okay to buy above this bar? Sure. What's the probability? Maybe 50-50, right? Maybe 50-50. If you take this buy, the probability is not high enough not high enough for a scalp. So you're taking it for a swing. If you're taking it for a swing, you're using a swing stop. So if you take that buy, I probably would put the stop above the most recent higher low. Okay, so it's a high 2 buy setup, doji signal bar, not strong, and not quite down to the trend line. So you can buy for a swing, or you could wait. So if you bought it, you'd have a bull entry bar, which is good, and good bull follow through, and then a small sideways move here. It's actually a tiny triangle. The market went down and up, and then down, so it's a small triangle, and it's a pullback from this bull breakout. So that's good for the bulls. So if you did not buy here, we have 2 bull bars here, this would be a reasonable buy, even though we never hit the bottom of the channel. If you bought here, the signal bar is only 4 ticks tall, so the initial risk is 6 ticks, 1 tick above the signal bar, 1 tick below the signal bar. With a bar that tiny, I would go for more than 2 times the risk. If your default stop typically is 10 ticks in the spider, you might try to get 10 to 20 ticks if you're going to have a limit order in the market to take profits. Otherwise, you can wait to see what the price action is. Maybe you can go for a profit target just short of a measured move up, maybe from this low to this high. Okay, so if you bought here and you took half off at 10 ticks, you were not alone. Look at the big tail on the top of the bar. So a lot of selling took place around that price level. Bull breakout, so probably good to raise your stop to below its low and you could swing the balance of your trade. Here we have an even stronger bull breakout, but we only have a few bars left to the day, so you could exit on the close of this bar, you could exit below its low, or you can exit at the close of the day. What about a with trend breakout of a channel? Alright, so if you have a bull channel, suppose it breaks to the upside instead of to the downside. A bull channel is a bull trend. Suppose you get a bull breakout of the bull channel. Most of the time, the bull breakout fails within about 5 bars, and the market reverses back into the channel and then tests the opposite side of the channel. Sometimes it does not. Sometimes it begins a stronger trend. Most of the time when you have a with trend breakout of a channel. This is Al Brooks, and this is my price action trading course. This module is about trading inside of trading ranges. In a trading range, my approach is simple. I buy low, I sell high, and I scalp. When you buy low, you can either buy to go long or to exit shorts. When you sell high, when you sell near the top of the range, you can either sell to go short or to sell out of longs. And scalp, you want a reward at least as big as your risk. Trading ranges occur every day, even inside of trends. And trading range days, where most of the trading is in a trading range, are also common. All trend days have trading ranges within them. For example, a trending trading range day is made up of 2 or more large trading ranges, and you only trade in both directions if the swings are very broad. Here's an example of a trading range. You want to buy low, sell high, and scalp. You want a reward at least as large as your risk. Okay? So the market is going sideways. We're getting near the top and near the moving average. So reasonable to short below a bear bar. Down here, 3, 4, 5 pushes up. I'm down near the bottom of a channel and a bull bar, reasonable long. A second entry long, or 2 legs down, 1 push, second push down. Failed bear breakout and reversal up. Also down near the bottom of the range. Possible higher low major trend reversal. Possible buy. Micro wedge top, a reversal bar, bull body, not ideal. You could take the first entry or you could take the second entry. A new low below the trading range, actually an expanding triangle, 2 pushes up, 1 and then 2, higher high, low, lower low, even lower low, and a very big bull reversal bar, worth buying. And you can see what happens even with a very strong bull spike. The market still turns down sharply. Trading ranges are always trying to break out. Strong bull bar, it failed. Strong bear bar, the bear breakout failed. Strong bull bar, strong bear sell-off, strong bull reversal, reversed again. Remember, most breakouts fail. You look to buy a reversal up from a breakout below a swing low near the bottom, and you look to sell a reversal down from a breakout above a swing high near the top. So we have a good bull spike. Here's a high, a pullback, and the market broke out again. We broke out above this swing high, and we broke out above these highs. So you look to sell a reversal down. Here we have a low. The market is breaking out. You look to buy a reversal up. Okay, here we have a new low. You can buy the reversal up there. You have a second entry here. We have a high, a breakout, a reversal down. There's your first entry. You might exit above that. Here's a second entry short. Here we have a swing low. The market broke below it. You could buy here, or you could buy a second entry here. You should look for clues early on that the day might be a trading range day. Yesterday, into the close, we had a tight trading range, lots of reversals, lots of big bars. And then, yes, we sold off here, but we had a tail, another tail, went above a bar, doji signal bar, reversed up, okay, big doji here. So we're in a tight trading range here. And that could be a clue that today would be a trading range, especially since yesterday was a trading range day. So yesterday was a trading range day, had intense two-sided trading into the close, and now we're getting pretty intense two-sided trading early on. So today could be a trading range day. We fell below yesterday's low and reversed up. We reversed up twice. Again, lots of tails, lots of reversals, lots of overlap, bull bars and bear bars alternating, so very two-sided trading. So this looks like a possible start of a trading range day. Well, if it might be a trading range day, the market typically breaks out to the upside and fails. So here we're breaking above a swing high and we have a bear bar. So that's a reasonable short if you want to bet that it's a trading range day, and that's a reasonable bet. When in doubt, you wait for a second entry. Sometimes you don't get a second entry. And this is what the market did after that reversal. Okay, now it's breaking out below the low of the day. But since today is a likely trading range day, you have to assume that the reversal up will test up to near the top of the range, and then it's an okay buy. Especially since when you look at this bear leg, all right? Yes, it's a very tight channel, but where are the consecutive bear bars? Where are the big bear bars followed by another big bear bar? We don't have that. We have doji bear bars. We have a bear bar here followed by some sideways bars, a bear bar here, doji, bull bar, bear bars with tails on the bottom. This does not look like a bear trend. It looks like a bear leg and a trading range. So that's also consistent with trading range behavior. Here's that long. The market went up, and now we're entering a triangle. You can draw triangles many ways. You could use this low as the first low. So 1, 2, 3, 4, 5, 6, 7. It doesn't matter. We're in a very tight trading range. We're in breakout mode. Are we near the bottom of the trading range? We're near the bottom of the 2-day trading range. We're pretty much in the middle of today's range. III, 3 inside bars, breakout mode. Traders will look to sell below and they'll look to buy above. Again, more evidence of trading range behavior. Another way to draw the triangle. Up, down, up, down, up, down. Another way to draw the triangle, you could start it up there, you could start it down here. It doesn't matter how you draw it, you just need to know that the market is in a very tight trading range and in breakout mode. Okay, the triangle broke to the upside. Traders might have bought above this inside bar. We have an III, 3 inside bars. They might have bought above this bar, they might have bought above this bar. And we have a strong bull spike, but trading ranges often race to the top and race to the bottom. So if you think this is a trading range day, we have a new high and a reversal. It is reasonable to sell on a stop 1 tick below that low. And this is what followed. A race to the bottom. Again, looking more like a bear leg in a trading range than a strong bear trend. Where are the consecutive big bear trend bars? They're not present. So we raced down to the bottom, double bottom with this low, possible higher low major trend reversal. You can view this as a bear trend or a bear channel, and then we have a bull breakout. And now we have a higher low major trend reversal in the form of a double bottom. We have a 2-bar reversal here. I think this is a reasonable buy. And this is what followed. We went above this high, no reversal down. We tried to reverse, we did not. We went above this high and no reversal down. So the trading range day was converting into a higher low major trend reversal. I do think you could buy above here. You probably could buy above here. Another breakout, an II pullback, a bull bar. You could buy above that bull bar as well, trying to capture what appears to be a trading range day converting into a bull trend. And you can also buy a reversal up from a final flag near the bottom. So if you get a bear flag near the bottom of the range, you can wait for the bear breakout and then see if it fails. And if it fails and starts to reverse up, you can buy the reversal up. And similarly, if you get a bull flag near the top, that might be the final flag. You can wait for the bull breakout to fail, and then look to sell the reversal down back into the trading range. So here we have a lot of two-sided trading, right? Possible bear leg within a trading range. We have a low too short, right? So a possible final flag. We broke to the downside, and we have a bull reversal bar. So this is a reasonable long. We have a bull flag up here. You can call it a wedge bull flag. 3 pushes down. 1, 2, 3. But it's near the top of what could be a developing trading range, just above the moving average. So you can look to short the failed breakout, the breakout if it fails. We broke out and we had a 2-bar reversal. That's a reasonable short, especially since this is a big gap down, a bear trend well below the moving average, and this is a gap bar, and this is a second entry gap bar short. So that's a reasonable short. Second signals, higher probability. So if you're at the top of or bottom of the range and you see a reversal, you can take the first reversal. If it does not look strong enough, wait to see if you get a second reversal. So for example, well, let's talk about this one. This is easier to see. The market fell below the low. It reversed up. Not a very good signal. And then we had a second signal here, higher probability. A strong bull spike. Traders might not want to take this signal, especially with that big tail. But then we got a second signal short right here, higher probability. So second reversals near the bottom to buy, second reversals near the top to sell. Trading ranges often have legs that have wedges in them. So if you have a wedge bottom reversing off the low of the range, you can look to buy it. If you have a rally in the form of a wedge near the top of the range, and it reverses down, you can look to sell it. 3 pushes down, 1, 2, 3, in a wedge shape. So this is a reasonable buy, especially with an II and a bull reversal bar. Now we have 3 pushes up, 1, 2, 3. I know this does not have a very good wedge shape, but I think it's still a reasonable short. I probably would not take this short because of these 2 big bull bars, but I do think the second entry makes sense. When the probability is not all that high and you're not certain, then you need to go for a reward that's 2 times your risk, but you always go for a reward at least as large as your risk. Once you determine your stop size, then you go for a profit just as big, and very often you have to quickly convert your target based upon actual risk instead of initial risk. Here the initial risk is above the signal bar, but once you were in the trade, your actual risk was right here. I don't have it drawn in, but this bar went down about 2 times actual risk. Same with right here. Your initial risk is below the signal bar right here, but once you're in the trade, let's say you bought above the bear bar, let's say you bought above the bull bar, your actual risk is here. 2 times actual risk is up here. Experienced traders can quickly determine actual risk and then adjust their profit targets based upon actual risk. So if you shorted below this bear bar, your initial stop is above its high. Once you had this strong bear bar, you could assume you could tighten your stop to above its high, and your actual risk is 1 tick above its high. Your entry price is right here, so 2 times actual risk is here. So traders could exit here 2 times actual risk. And the same with the bottom over here. Let's say you bought above the bear bar. You could do the same argument buying above the bull bar. But let's say you bought above the bear bar. Your initial stop is below the bear bar. But once the market started to turn up, you were able to see that your actual risk was to this point. So you went long at this red line right above that bar. Your actual risk was here. So 2 times actual risk is here, and you could take your profits there. I think for a lot of traders, it takes a little experience to convert to exiting based on actual risk instead of initial risk, but I think that's the best way to do it, and you should try to do that once you have the experience. Getting stopped out often, most traders don't worry about it. They just take the loss and they look to enter again on a second signal. So if a trader took this short and they had a tight stop, and they were stopped out here and got a second signal, they would sell again. One alternative to that is to use a wide stop. If you're using a wide stop, you should trade small because your risk is bigger, and it keeps you from getting stopped out of what could ultimately be a good trade. And if you're trading small and then get a second signal, you can put the rest of your position on once the second signal triggers. So let's say you took this short, right, and you were not certain if you picked the exact top. You might use a wide stop, like maybe a measured move up based on the height of the signal bar. So you trade small, you'd hold short when the market breaks above the high of this bar, and then you have a second signal. You can put the rest of your position on during the second signal. Okay, here, let's say you took the second signal. Actually, this is to illustrate limit orders. Okay, you have a bull flag, but it's at the top of what is probably a trading range. So probably more sellers than buyers above. Experienced traders won't take this buy. They won't be buying bull flags at the top of a trading range, especially when we keep getting failures like we are right here. Instead, what they'll do is they'll bet that this will fail as well, and they'll place a limit order to go short at the high of the prior bar. So they would have been filled here. Initial stop, they may have initial stop above the high of the day, and then they would look to take profits, maybe 1 times the initial risk, maybe 2 times the initial risk. In this situation, I think most traders, after this bear bar triggered, they'd tighten their stop to 1 tick above its high, and then they could try to get out at 2 times their actual risk, which would also probably be right around here. If they shorted here and their stop was moved to here by the close of this bar, this would probably correspond to about 2 times their actual risk. If the risk is very small, you should try to go for a bigger profit target, like twice the size risk. So for example, let's say you bought on a limit order at the low of this bar, betting that it would be a bad short at the bottom of a trading range, right? Your initial stop, you might put it below the low of the day. Your risk is very small, so you might go for twice your risk. Let's say you bought on a stop above the bar. Again, you could go for twice your risk. So when you have small risk, you should not go for a target that's equal to only 1 times the risk. You should go for a bigger target. Tight trading ranges, let's say the distance between the bottom and the top of the range is very small, so the range is very tight, and the market has lots of reversals, reversing every bar or 2, and the breakouts above the high of the prior bar are only 2 or 3 ticks. The breakouts below the low of the prior bar are only 2 or 3 ticks. Tight trading ranges, they trump every reason that you can come up with for entering on a stop. Stop entries are losers in tight trading ranges. So beginners, when they see the market entering a tight trading range, I used to refer to those as barbed wire patterns. Beginners should stop trading because beginners should only be entering on stops. And when the market is in a tight trading range, that's the exact worst time to be entering on stops. Experienced traders are doing the opposite. They're buying below the lows of bars and they're selling above the highs of bars. And you can't be doing the opposite of what the institutions and the experienced traders are doing, because you'll lose money. So you wait for the tight trading range to end. It ends after there's a clear and strong breakout, and then you can go back to stop entry trades. Half of the breakouts from tight trading ranges, once you get totally free of the tight trading range, half of those breakouts fail. Sometimes you can enter with a stop entry in a tight trading range. If the distance between the bottom and top of the range is big enough and you get a small bear reversal bar near the top, you can scalp below. If there's a small bull reversal bar near the bottom, you can buy above. So here's an example. We're obviously in a trading range and it's very, very tight. We have a small bear reversal bar near the top, so you could consider shorting that. We have a small bull reversal bar near the bottom, so you can consider buying that. Most traders, if they're starting out, should not take a chance, and they should just wait. This is what I was talking about. You could short below that bar for a scalp or buy above this bar for a scalp, even though the market's still in a tight trading range. As I said, experienced traders and institutions will take scalps using limit orders. They'll sell with limit orders to go short above the highs of bars, and they'll scale in higher, and they'll buy with limit orders at the low of the prior bar and scale in lower, and they'll just be scalping. So here's an example. The blue boxes are where experienced traders will be shorting above highs of prior bars. The green boxes are where the experienced traders and the institutions and the computers will be buying. They'll be betting that the breakouts will fail, and they'll be right almost every time. So when they're finally wrong, whatever they lose on that last trade will not be enough to erase all that they made on the earlier trades. Most traders should not do this. It's very difficult to do. It's draining, and the reward is not all that great. Best thing to do is wait for a clear breakout and wait for the market to turn more into a swinging type market where you can enter on stops and try to get swing profits. And I mentioned that some traders will scale in. Okay, so if a trader bought the low of this bar, okay, maybe they'll buy again 1 point down and buy again 1 point down, right, and use a wide stop. However, once they had this strong bear breakout and they're long, they're probably going to be happy to get out break even. So they'll probably place a limit order to get out break even on the trade, which would be right around their second entry. So they lose a point on the first entry, they make a point on the third entry, and they get out break even on the third. And again, this is all hard to do, and you have to make decisions very quickly, and I think it's too much to expect people to do when they're just starting out. And that is the end of the module on trading within a trading range. This is Al Brooks, and this is my price action trading course. This module has to deal with trading the opening range, looking for swings on the open. The market tries to form a trend on or shortly after the open on most of the days, and most of the attempts do not look quite good enough, and they fail. But if you look for reliable setups, you can take some swing trades that are pretty profitable, and they're pretty consistently profitable. The opening range is a good time to look for. So when does the opening range end? There's no specific time. It's different every day, usually around 8:30. It might be as early as 7 o'clock, sometimes as late as 10 o'clock. And then the day enters the middle third of the day. And then the final third of the day is the trend into the close, if there is a trend. I tend to divide the day into 3 parts. So why trade the open if you're trading the first hour or two? Because either the high or the low of the day tends to form early, and that means if you catch that entry, you can swing trade and have a reward much bigger than your risk. So either the high or low of the day forms in the first 5 minutes, about once a week, 20% of the time. Either the high or low forms in the first hour, half of the days, and either the high or low forms in the first 2 hours, 90% of the days. So if you're looking for a swing trade in that opening range, on most days you're able to find one. You should always be looking for major trend reversals, and you should be looking for a breakout of something, either a swing high or low, including the high of yesterday, the low of yesterday, a breakout above a trend line, above a trading range, above a channel, below a trading range, above or below the moving average. Always looking for a breakout of something. Okay, is the breakout continuing from the first bar? So if you from the first bar of the breakout, or is it reversing? So you're not only looking for a breakout, you want to make sure that it continues after the first bar of the breakout. And it's equally important if the breakout fails and reverses. If it's failing, is the market just pulling back a little bit, like to the moving average, and then will the breakout resume? or is the breakout failing and leading to a reversal swing trade? Okay, swings usually begin with a pretty strong signal bar. So a bull swing usually begins with a bull body and a close at or near the high of the bar. A bear swing usually begins with a bear body and a close at or low or near the low of the signal bar. Okay, breakout or failed breakout. You should see the modules on breakouts, major trend reversals, and on trading strong bull and bear breakouts. On the open, I'm always looking for breakouts, failed breakouts, and breakout pullbacks of anything, trend lines, trading ranges, prior highs and lows, and I look for reversals. So here we had a big gap down, breaking well below a trend line, and it was a failed breakout. And then we had, for the bear case, this is a pullback from the breakout. We have a small trading range yesterday. We broke below it. We tried to have a failed breakout on the first bar, and it tried to become a breakout pullback, a pullback short, and instead we reversed up a second time. So it's a failed breakout below yesterday's low twice, so it's a second chance to get long. Here we have a bear channel, and we broke below it on the open, and we had a small pullback, so it's a breakout pullback short. Here we tried to form a double bottom major trend reversal, and on today's open we tried to break out above a trend line, and it failed, so we have a failed breakout. Here we have a strong breakout, a gap up and a big trend bar, and we pulled back two legs, a small high 2, so it's a breakout pullback. And then we tried to break out of the high 2 here, and we pulled back again, so a pullback from the breakout of the high 2. You should always be looking for swing trades during the opening range. Again, the most common ones come from breakouts, breakout pullbacks, and failed breakouts. So here we have a bull channel going to the close. We broke below it on the open. We pulled back to the moving average. So a breakout pullback short, a small double top at the moving average, a reasonable swing short. We broke out on this day above a double top, and we pulled back. So we have a breakout pullback buy. Here we broke out above yesterday's high, but it failed, and there's a small final flag here as well. So on the open, we raced up, went sideways, and had a brief breakout that reversed at yesterday's high. So it's a failed breakout above yesterday's high and a small final flag reversal. A bear channel into the close, a gap above it on the open, so a breakout, and then we pulled back and reversed up near yesterday's low, so a breakout pullback. We had a bull channel for most of the day, two legs down into the close, a high 2, and we gapped up above yesterday's high, trying to break out above yesterday's high, but we reversed down immediately, so it's a failed breakout. We sold off sharply for many bars, and then we rallied back up to the area of yesterday's trading range, and this turned out to be simply a pullback from this strong bear reversal, the strong bear breakout. The first few bars of the day often tell you whether the day is likely to be a trend day or a trading range day. Here we have a strong bear bar closing on its low after gapping up. So that's a trend type bar, and we had decent follow through, so that increases the chances that the day would be a trend day. This chart, by the way, shows you what I mean when I say I tend to divide the day into thirds. Here we had a trend from the open, so the first third of the day, and then we went sideways, and the market had to decide whether the trend from the open was going to have follow through and resumption into the close, or whether it would fail and lead to a reversal day. So you often have a trend on the open, and then a counter trend move or a sideways move in the middle of the day, and then the day decides whether to resume the trend from the open or whether to reverse it. So the current module and the two modules following it have to do with exactly this structure. The current module is what to do in the first third of the day. The second module is what to do in the middle of the day. And the final module is how to trade the final third of the day. Okay, the trend from the open, it doesn't have to be from the first bar. It can be 2, 3, 4 bars later. Here we have a 2-bar reversal after a gap up, bar closing on its high, a reasonable swing buy. We have good entry bar and good follow through, so by the time these two bars closed, the day was clearly always in long in the eyes of traders. So if you did not buy above this bar, you could buy that close or that close or this close, betting that you'll get at least a measured move up based on the height of the bull spike. Alright, so I mentioned that the first few bars of the day can give you an idea about what to expect for the rest of the day. First bar of the day, a bull trend bar, but a pretty big tail on top and bottom, so a trading range type bar. Next bar, an inside bar, trading range type bar. A small bar, small body, tails on top and bottom, trading range bar. We tried to break out, but a big tail on the bottom, so a questionable trend bar. Next bar, bear follow through, but another big tail, and then another big tail. And then we traded above the high of this bar, so we have a reversal attempt, but a big tail and a doji bar. The trend tried to resume, but a doji signal bar, not good, not reliable, and then a big reversal with a big tail. So lots of reversals, lots of tails, no two consecutive strong bear bars. We have 3 bear bars here, but big tails on the bottom. So if you see lots of two-sided trading, buying pressure, selling pressure, alternating bear and bull bars, prominent tails, lots of reversals, lots of overlap among the bars, and you look at the chart and you say, oh, I don't know if it's going to go up or down. So in other words, you feel confused. If you feel anxious, like, oh my gosh, I got to put on a trade, but none of these setups look right, then you feel anxious. All right, and you see no strong gaps, no bars closing well below the lows of the prior bars, no bars closing well above the highs of the prior bars. You know, those are all signs of trading range price action, and it increases the chances that the day will be mostly a trading range day, which this was. Yes, it was a reversal day. We opened, we sold off, and we closed back up, but most of the price action during the day was trading range price action. And the first couple bars of the day, and then the first 10 or 15 bars of the day, gave a clue that the day was likely to be a trading range day. The day usually continues the behavior that it had early on in the day. Here's another example. Lots of bars. They're big, lots of overlap, no consecutive trend bars up or down, big tails, top, up and bottom, small bodies. Okay, so this is probably not going to be a trend day, and therefore it's probably going to be a trading range day. Trading range day, you want to buy low, sell high, and scalp. And you expect that all the strong bull spikes will result in sell-offs, okay, and they did. And every strong bear spike will result in a rally, okay, which it did. Okay, the first few bars of the day often indicate whether the day will be a trend day or a trading range day. You should also pay attention to yesterday. If yesterday was a trading range day, today probably will be a trading range day. If yesterday was a good trend day with lots of swings, strong swings, today will probably be the same. The market has inertia, and it tends to continue what it's been doing. The next several slides, the next many slides, is a week of trading the open on the spider. So it's the opening range of the spider for 5 consecutive days. Again, looking for reversals, breakouts, and failed breakouts, and looking to swing using usual management techniques. So I'll go through it one day at a time. Here's Monday, and first 2 bars of the day, big doji bars. Okay, so that tells you trading range price action. And look at yesterday, a tight trading range, and the activity is continuing into today. We tried to break out below the bottom of the trading range, and we have a big bull inside bar. So, and it's also a high 2. There's a high 1 here, and one above bar 1, and then a high 2 here. So I think this is a reasonable buy for a possible swing, but I would be concerned that yesterday was a trading range, and the first 2 bars here are trading range type bars. So this might be a trading range day. However, this is a reasonable buy. Alright, the third bar from this reversal has a bull body, probably buyers below, so I would not exit my long. I probably would keep my stop below the signal bar or below the entry bar and then hold. And then look what happened. We had trading range activity again, So from here over to here, lots of prominent tails, good selling pressure on tops of the bars, some bear bodies. Yesterday was a trading range. We tried to break out of the bottom, we reversed up. Now we're trying to break out of the top, and we have a bear signal bar. So to me, that's a reasonable short, especially since it's an expanding triangle. And an expanding triangle top, to me, is a form of major trend reversal, higher high, major trend reversal. So also up here, you can argue this is a wedge. There's a 1 push here, 2 pushes there, and 3 pushes here. So on today, so far, it's also a wedge. So to me, this is a reasonable short. So the market sold off, tried to bounce here, sold off again, and then tried to double top here. Okay, this is interesting, and this is important. The first rally went above the entry price for the bears. It did not go above the entry bar or the signal bar, but it went above the entry price, and then the bear resumed. In general, at that point, I would move my stop to break even. So if I was trying to swing until there was a clear buy signal, at this point, I would have my stop at break even, because I don't want the market to come back to my stop a second time. On strong days, it does not do that. And then look at this rally. The market had 6 consecutive bull bars, so it's looking pretty strong, trying to break out. But look what happened at this high. Okay, it did not hit a break-even stop. That's a sign of strength on the part of the bears, and this is a reasonable second entry short. Your first entry was over here, and now you have a second chance to go short. We're in the middle third of the day here, so this is really has nothing to do with this module, but I'm bringing it up because it's illustrating a point. The bears don't want the market to come back to their entry price a second time, and if they do, they'll exit. If it just misses the entry price, misses the break-even stop, it's a breakout test, and it's usually a good short for a second entry. All right, look at yesterday. We had a strong bear spike, another bear spike here, smaller one here, here, here. Okay, so it's a series of consecutive sell climaxes, but there was some buying pressure along the way. Tail, tail, bull bar, dojis, tail. Okay, tail into the end. Possible 1 bar final flag. Right. Most of the time, when you have these parabolic sell climaxes, you can call it a parabolic wedge because it has 3 pushes. Here, it actually has 4 pushes. Most of the time, 2 out of 3, the market gaps up the next day and has a pretty good correction. 10 bars, 2 legs, sideways to up. First bar of the day today, a strong bull bar closing on its high. To me, I think it's a possible low of the day, given that we should have 10 bars, 2 legs, sideways to up. We might get back up to the top of this channel, spike and channel. We may get all the way to the top of this channel, spike and channel, right? So to me, I think this is a reasonable buy for a swing up. 1 bar final flag here. Consecutive sell climaxes, it's like any other type of climax. If you get a reversal, the reversal usually goes for 10 bars and 2 legs. It doesn't have to be exactly 10 bars or 2 legs, but usually it's at least 10 bars, and usually it's at least 2 legs. So you can buy above the high of this bull bar. The bears tried to sell it off. They could not get below the low of that bar. And now we have a strong bull breakout bar. Its close is above the high of the prior bar. It's a very big bar. It's a close above the moving average. I think you could buy that close as well. You probably have to put your stop down here. So if your stop is too far away, you have to trade smaller. I think that bar is strong enough to flip the market to always in long. Most traders, I think, felt it was always in long when the market went above this very strong signal bar. But this bar, I think, is enough to make traders confident that it's always in long. So you can buy for any reason, including just the close of the bar. Another very strong breakout bar. So if you did not buy this close, you could buy this close. You can see the module on trading strong bull breakouts to get more information on how to trade these things. But now we have 2 very big bull bars, both closing on their highs, very little overlap, small tails, very strong. It should result in a measured move up based upon the open of this bar to the close of that bar. So I think it's strongly always in long. Yep, we have a pullback. That's okay. Tight trading range. A little bit of uncertainty. I think the market's still always in long, and it should go higher. So you look for any reason to buy. Here's a high 3. Here's the high 1, high 2, high 3. So it's a triangle and a bull trend holding above the moving average. Bull body for the signal bar. Despite the tight trading range, I think this is so strongly bullish, I think it's okay to buy. You can also argue it's a higher low major trend reversal. We had a bear trend, a very strong breakout of the trend line, and a pullback. Pulling back for about 10 bars or so. Yes, the pullback did not pull back very far, but it's still a 10-bar pullback. And I think you can argue that this is a higher low major trend reversal. The rules for major trend reversals in the first hour, I tend to be a little bit looser with the rules because the market so often goes for swings and the setups are often not ideal. And this is what followed. We had a strong bull spike and then a weak channel. Okay, lots of overlap, some pullbacks along the way, a test of yesterday's double top. To me, I would be looking for reasons to take profits. We have an IOI, second entry short. Here's the first entry below this bull bar. To me, I would exit below this bear bar and assume that the market is transitioning into a trading range. Channels usually transition into trading ranges, and we're back up into yesterday's trading range. So this is likely to result in a trading range. So I would exit. Okay, what about the management of that initial long? You buy above the signal bar, the first bar of the day, and your initial protective stop is below the low of your signal bar. Alright, so what happens after we have these two strong bull bars? You can raise your stop. Certainly, the first place you would raise your stop is below the most recent higher low, which would be this bear bar, or below the bottom of the bull spike, which would be this strong bull bar. Now, you could calculate your actual risk, which is one tick below this bear bar, to your entry price, one tick above this bar, and go for a measured move to twice your actual risk, which is here. Or you can say, gosh, this bar is so strong, we're going up higher, and look for some other reason to take profits. Maybe 2 times your initial risk, below the signal bar, above the signal bar, measure twice that distance. So let's say you did that, you would take some off here. That's assuming you bought over here. If you bought this close or that close, you would go for some other measured move target based upon how much you're risking. Either you're risking below this bar or below this bar. You don't want to take profits too early when you see a bar that looks like this or a bar that looks like that. Alright, so now we have a new high on the trend day. Alright, so far it's a bull trend day. So you probably would raise your stop from below here to below the most recent higher low. Right? If the market falls below this, then your premise that it's a bull trend day might be wrong. You want the day to be making higher highs and higher lows. So after every higher high, you raise the stop to below the most recent higher low. If it falls below this low after going above this high, you have to question your premise that it's a bull trend day. It probably would then be a trading range. And if it's a trading range, you trade it differently from how you trade a trend day. And then up here, this is where you take profits, either below the IOI bar or below the bear bar. And the channel did evolve into a trading range. At this point, you look back and you say, where did the trading range begin? You'd say over here. However, when you were at this point in the day, you'd say, wow, this is a channel in a bull trend. So yes, it's a bull trend, but it's also part of a trading range. Alright, Wednesday, what do we have? We have 2 large legs down in a bear channel, so it's a bull flag, and we broke out on the open with a bull bar and then another bull bar. But the bull bar has tails on top, so probably bear scaling in above. And now we have a bear bar closing in its middle, but we have two-sided trading here. Tails on 1, big tail on 2, bear bar on 3, even with the tail. To me, this is a reasonable short for a failed breakout above yesterday's high. And it's a decent signal bar. I don't like the size of the tail, but it's still a reasonable enough signal bar for a failed breakout, especially since yesterday had a lot of two-sided trading. You have to assume that today will have some as well. Now you can draw a trend line. You can make it pretty vertical. We can see this bear bar is a breakout bar, right? It broke out of something. It broke out below below the low of the open and below these two bear bars. But you could also argue that it broke below a trend line. You could draw a very steep trend line here, and that would make this a potential lower high major trend reversal, right? We tried to have a failed breakout above yesterday's high, and the bulls tried to resume, and they're failing again, so we're probably going to trade down lower. So you could short below these doji bars. I prefer to short below bear bars, so I probably would short one tick below the low of that bear bar. You can say, well, Al, there are not enough bars in this major trend reversal pattern. Enough bars on the sell-off, 6 or 7 bars, but the rally only was 3 bars. In the opening range, I tend to be more flexible with the rules, and I'm eager to look for swing trades, and a lot of times major trend reversals happen with legs that are not as many bars as I would like to see at other times during the day. So bear breakout and follow through. You could sell that close, you could sell this close. With the big tail on the bottom of the bar, I would be a little bit hesitant, and I would be quick to get out. I probably would scalp this one. So big bear breakout, we got the sell entry bar, great follow through, so you can sell that close, maybe sell this close. But now we have an inside bar, so a possible 1 bar final flag, and a possible 3 push down pattern. So this could be a parabolic sell climax testing yesterday's closing range. 1 bar final flag, and now we have a 2 bar reversal. Either this bear bar and this bull bar, or these 2 bear bars and this bull bar. On some higher time frame chart, these 3 bars are a reversal bar, like a 15-minute chart. It might be a perfect 15-minute reversal bar. So to me, it's reasonable to go long. Parabolic wedge, reversing up from yesterday's closing range, and a 2 bar reversal, so you buy above the high of the bull bar. At this point, another bull body, maybe always in long. At this point, a third bull body closing near its high tick. I think most traders would assume the market's always in long and it's going higher. We'll probably get a measured move up based on the open of the start of the spike to the close of the finish of the spike. And that's what I think ultimately we got. Thursday, all right, you could possibly sell this as a low 2, but when the market formed the high 2, especially with the bull bar, you'd get out. You could possibly sell this bear bar, but 2 strong bull bars, not all that reliable. You could buy this 2 bar reversal, but why does it have this big tail? So, there are no great signals so far, and I think it's okay to wait. The high, you got a second entry short, but a doji signal bar, not very strong. The problem is today has an FOMC report, Federal Open Market Committee, the Fed, reporting at 9:30. So, with the signal bars all being weak and the setups all being weak, I would wait until after the report to see if we get a breakout up or down. And this is the report. You can say, well, that's not anything special. Well, it is. These bars had good swings, good size range, and this bar is so much bigger than all of that. This is a huge bar. It's about 1% of the range of the S&P occurring in just a matter of 1 bar. So this is a huge bull breakout, and chances are it's going to have follow through, and it ended up resulting in a huge day. So you could end up buying on the close of this bar or above the high of this bar or any of these other bars. This is not in the opening range. In the opening range, we really did not have any good setups. But this is a setup in the middle third of the day, and it led to a very good trend. All right, here's another day, Friday. This is that FOMC report and the huge bull trend. And we ended with basically a sideways double bottom, 2 legs sideways, a leg down here, two-legged move up, another leg down here. So it's a double bottom, it's a high 2, it's an ABC, and then we gapped up, and the first bar of the day opened on its low, closed on its high. So we may be getting follow-through buying from yesterday's strong trend. So you could buy above 1 on the first bar of the day, looking for a trend from the open bull. Third bar, good follow-through. Fourth bar, okay. Fifth bar, another bull bar. So now we have 5 bars up. I would not short below 5. Should be buyers there. This bar fell below that bar and found buyers, and the market turned up. But what happens up here? Okay, we have a reversal bar, a bull body, but we've had a series of strong consecutive bull climaxes without much of a pullback. Here, another spike here, another spike here, here, and then today's open, and then here, and then here. Chances are the market's going to have at least 10 bars and 2 legs sideways to down. To me, this pattern would be consecutive buy climaxes on the 15-minute chart. When you look at the number of bars involved, 40 or 50 bars, I'm not looking for just 10 bars and 2 legs on the 5-minute chart. I'm looking for 10 bars and 2 legs on maybe the 15-minute chart, which means 2 legs but maybe 30 or more bars on the 5-minute chart. So very extreme buying, consecutive buy climaxes, and you can also think of this as a very tight wedge, the high of this bar, and then here the market overshot the top of that trend channel line, the top of the channel. I don't have the trend line drawn in below, but it has a wedge shape. So this might be the start of a big correction. So I think it's a reasonable swing short. Okay, why take it if the probability is not all that good? Because the reward is many times bigger than the risk. The stop is above the high of the bar. The entry is below it. It's a very small bar, and you might get a pullback all the way into this potential final flag. So the reward is many times bigger than the risk. And that is the end of my module on trading opening range swings. This is Al Brooks, and this is my price action trading course. The current module has to do with trading swings in the middle of the day. Many days have 3 parts, and there tends to be an opening range, and then a trading range or channel in the middle of the day, and then a trend in either direction at the close of the day. Here's an example. So the opening range in this day was small. Trading range in the middle of the day lasted about 4 hours. And then there was some trend resumption in the final 90 minutes. So we had a bull trend, sideways, and then a bull trend. So we have trend resumption into the close. Today I'm talking about this pink area, the middle part of the day. The opening range sometimes can last all the way out here. So sometimes the green box can be very big, the pink box can be small. Sometimes the blue box can be small, sometimes it can be big. The different parts of the day can start and end at different times. Here's a day where the opening range was, the opening move, the trend was small, just about 10 bars or so, not even 10 bars. And then we had a trading range for the middle part of the day, and then a trend resumption into the close, and then a trading range after that. So to me, these are the 3 parts of the day. We had a bear trend, trading range, trend resumption, and then pretty much dead zone after that. Okay, here's an example where we have a bear trend initially, and then a trading range. Instead of resumption of the bear trend into the close, we have a reversal. So when you have that initial trend and then a trading range, it can either lead to trend resumption or a trend reversal, as we have here. Here we had a bear trend and then a bull trend, a weak bull trend in the middle, and then the end of the day ended up with a trading range. So pretty much any combination can develop. So trading trends and trading ranges, you can see the modules on them. There are modules about trading in trading ranges, and then another series of modules on trading different types of trends. And I also have modules about trading the opening range and then trading swings into the close of the day. When does the middle third of the day begin? It's different every day. It's usually around 8:30. The trend in the open usually ends around 8:30, sometimes as early as 7 o'clock, sometimes as late as 10 o'clock. So you're looking for some kind of reversal after the opening range swing. So it might lead to an opposite trend, it might lead to a trading range, and if it does lead to a trading range, often there are big swings within the range, big enough to make swing trades. If the trend continues, if you want to see what to do, you can look at the modules that talk about how to trade trend days. If the middle third of the day becomes a trading range, you can see the modules on, or the module on trading within trading ranges for additional information. Middle third of the day, weak channels, in other words, weak trends, are very common. On most days, the middle third of the day is relatively unclear, and it does not have a strong trend. There might be a channel, which is a weak trend, or a trading range. That's the most common situation in the middle third of the day. A channel, in other words, a weak trend, or a trading range. Usually there's enough movement for a swing trade, but a lot of times there's not, and you're left with scalping or waiting. All right, so look at this day. We had 3 pushes up on the open, right? You can argue a wedge top, and then we started to enter a trading range, but then we broke out. All right, we had a strong bear breakout with follow-through. So we have a bear breakout and 5 consecutive bear bodies, right? So at this point, somewhere in here, everyone was agreeing that the day was now a bear trend day. Probable bear trend day, you can see the modules on trading bear breakouts and on trading weak and strong bear channels. At this point, we have a bull inside bar, and the market might be trying to reverse. But this is a 5-bar bear spike, and I think the market became always in long, either on that breakout bar or within a bar or two after that. So as long as the market is holding below this high, I think it's still always in short. Excuse me, always in short. It's possible that we're reversing up from the low of the day, and that this will result in a bull trend day. But right now, I think the odds are it's always in short. Okay, we've got some follow through here, another bear breakout, and another follow through, but a bull inside bar. So this could end up being a failed breakout. All right, we have a small double bottom and a bull inside bar, but we're still pretty much in a bear channel. We have not had much buying pressure, right? We have not had a strong bull spike. We have not had 5 or 10 bars up breaking the trend line, right? So it's not yet a major trend reversal. So to me, I think this is always in short, and these are bear flags. We have 2 little pushes up here, 1 and 2. We're still below the moving average, so this might be a short. You could also think of it as a triangle, 3 pushes up, 1, 2, 3. So is it a bottom or a bear flag? To me, I think it's always in short, so I assume every attempt to reverse will be a bear flag. So I'd rather short below than look to buy. We got a 2-bar reversal here for a good signal for the triangle short. 3 pushes up, 1, 2, 3. And there's the bottom of the triangle. So I think that's a reasonable short. Certainly for a scalp, and you can also do it for a swing. It looks like we're holding below the moving average. So we got a 2-bar reversal here and a triangle. Is this a final flag, and will this reverse up? Well, we got 4 consecutive bear bars here, 2 more here, so 6 out of 7 bars bear bodies. I don't want to buy until I see a strong bull breakout and then some kind of test of the bear low, creating a major trend reversal. To me, we've got a spike down, and it looks like we're making lower lows and lower highs, so this is a bear trend. Yes, there's overlap and there are bull bodies, so you can call it a bear channel, but it's still a bear trend, and I think it's too early to be looking to buy. I would look at every reversal attempt as a possible new bear flag. So we have this 2-bar reversal, and we got a bear inside bar, and we sold off a little bit more. Another bear breakout and good follow through. You can say, well, it's consecutive sell climaxes, and we'll get a strong reversal, and we might. But until I see a strong move up, I'm going to assume that this trend will continue forever. I know at some point I'll be wrong, but I'll be right many times in the meantime. So I think it's still too early to look to buy. As far as how to place trades in here, again, you should look at the modules on trading bear trends. This is a strong bear trend, and now this is a channel, so it's a weak bear channel, a weak bear trend, but it's a very tight channel, so it's basically the same as a strong bear trend, even though it's a channel, and a channel by definition is a weak trend, certainly weak compared to a breakout. Alright, so we may be getting a parabolic sell climax here, and we may come all the way back up to the top of the channel, but still I'd like to see a major trend reversal before I look to buy. Any buy at this point is only a scalp. Looking better for the bulls, possible double bottom, 2-bar reversal, but we did not even hit the moving average. So far you can say, well, we broke a trend line. Yeah, but it's only 3 bars up, 4 bars up. Not enough buying pressure. Alright, so these bulls are disappointed at this point. So now we're getting another bear triangle. A push up here and then down. A push up here and then down. A push up here. So to me this is another triangle similar to this. So it's a short below. For the bulls, they can say, well, we reversed up here and it's a triangle bottom and it should lead to a reversal. Well, I'll wait until we break strongly above the moving average, and then I'll look to buy a pullback. I'll wait until I see a major trend reversal. Otherwise, I'm going to assume that this trend will continue down forever. Another bear breakout, another 2-bar reversal, another attempt at a bottom. To me, we're trending down. Again, you can look at the modules on how to trade bear channels, weak bear trends, to see specifically how to trade here. Trends are always trying to reverse, but you got to remember the market has inertia. 80% of the reversal attempts will fail. So you got to go with the odds. And in a bear trend, you should be only looking to sell until there's a significant reversal in place. You have to trust your read. If you look at the chart and you say, okay, I know the market cycle trend or trading range is a trend, and right now it's channeling. So, you know, it's a weaker trend, but it's still a trend, right? So it probably will continue lower. Probably means that you're 60% confident, and you should only be looking to sell, and you should not look to buy until you see a major trend reversal. Here's some examples on how to sell. I mentioned there was a triangle here. You short below the bear bar. Another triangle here. You can short below the bull bar or below the bear bar. Here's a small double top with a bear signal bar. You can take that short. Here we got another breakout and 2 little pushes up. We went down here and then up and then down again and then up. So on a smaller time frame, that's a low 2. You can just look at it as an IOI with a bear bar for a short on this 5-minute chart. You should be looking for swing shorts in a bear trend. So if you shorted below this triangle signal bar, your initial stop is above the high of the signal bar. Your entry is over here. If you're going for 2 times your initial risk for taking half off, you would have gotten out over here, and you would take out your final profit going into the close. There were no good reversals all day long, and now we're getting a big sell climax into the close. I would exit above this bull bar. The bears tried to sell off here. Instead, they got a bull bar, and I want to exit before the close. There's a chance we may bounce up into the close, especially since we had such strong buying earlier. The bulls may come back into the close, so I would buy back my shorts above this bull bar. When you find that your protective stop is small, let's say your signal bar is small, don't exit with a profit of only 2 times your risk. You know, everybody has a default risk, right? For example, in the E-mini, currently a 2-point stop and a 2-point target is the minimum for a 60% scalp. So the default risk in the E-mini is 2 points. It would be 20 ticks in the spider. If your signal bar is only 5 ticks tall in the spider, that means your risk is 7 ticks, 1 tick above for the stop, 1 tick below for the entry. And you may decide that, well, it's a pretty good bear trend. I don't want to go for 2 times my actual risk, my 2 times the size of the signal bar. I'll go for 2 times my default risk. My default risk is 20 ticks, so I'll try to exit at 40 ticks. So for example here, your actual risk in this particular instance is 1 tick above the signal bar. Your entry price is 1 tick below. The bar is 8 ticks tall, so your actual risk is only 8 ticks. You normally are willing to risk 20 ticks in the spider. Here you're only risking 8. If you go for 2 times your actual risk, you'd be getting out here. You can see it's a pretty strong bear trend day, and at this point it's a small pullback bear trend day, so it's probably going to go much further. So instead of using 2 times your actual risk, you might use 2 times your default risk. If you normally risk 20 ticks, why not try to get out 2 times that, or 40 ticks, right here. And at that point, move the stop to break even and swing the balance. Here's an example of a possible reversal at the end of the morning trend. The day might become a bull trend day or a trading range. Alright, so we sold off on the morning. We had a double top. Lots of two-sided trading yesterday and today. It's possible this is simply a failed breakout. You can say it's a parabolic wedge. 2 pushes down, 3rd push down. Possible low of the day, right? Right now, this is not, I think, a strong buy signal. We have a bear trend from the open. We started selling off on the open. And we had the double top, and we're selling off again. Okay? But you can draw a channel, right, across these 2 lows, and we're right at the bottom of the channel. So is this breakout the start of a strong bear trend, like a spike in channel, or is it simply a sell vacuum test of the bottom of the channel? And we don't know at this point. So it might be the low of the day. Not a good looking signal bar. You could take it for a swing long, but right now I think it's really not a reliable buy. Alright, so what happened right here? Let's say you did buy above that bear bar. Excuse me. It's a reversal bar, close above its open, but it has a bear body, so it's not a strong signal bar. You could buy above it. I think it's an aggressive long. You probably would feel pretty good at this point, because for the bears this is a pullback from their breakout to a new low of the day, and instead of having a strong entry bar, they got a doji close. So let's say you took the aggressive buy, 6 consecutive bars down, hoping that it's a sell vacuum test of the bottom of the channel. Okay. Your initial stop is below the low. Since you'll probably lose on the trade, right? The probability is less than 50-50. You have to go for a reward twice your risk. So if you take this trade, your initial risk is below the signal bar. This has to be your initial target. If you're going to have a positive trader's equation and you're taking a trade that only has a 40 to 50% chance of success, you have to go for a reward twice your risk. This is looking pretty good at this point, right? We tried to trigger a low 2 short below here, and we ended up with a bull outside up bar. So at this point, it's looking pretty good. So at this point, the market may even be always in long. We've had 4 bars without a bear body. You could adjust your risk based upon, you could adjust your target based upon actual risk. At this point, you could say, well, at this point, we're probably always in long. My actual risk was below the low of this bar, so 2 times my actual risk would be somewhere around here. Mathematically, that is acceptable. We had another 3rd attempt by the bears to sell off, but we held above the most recent higher low. So we're forming small higher highs and higher lows. This is a wedge bear flag, 3 attempts down, and we're failing. We're trying to get a bull breakout here, so you could buy above this bar or you could buy that close. big bull close, big bull bar relatively, close well above the high of the prior bars and above the moving average. So this could be a breakout that could lead to a measured move up. If it does lead to a measured move up, the measured move would be from the low of the pattern to the high of the breakout point, and that would be right around here in the general area of your original target based upon 2 times your initial risk. So this may end up being a measuring gap. So if you did buy above the high of this bar, or if you bought that close, your stop is below its low, and you're looking for a measured move up, which is probably more than twice your risk. After every strong bull bar, you trail your stop to below its low. So if you bought above this bar, or if you bought this close, or if you bought down here, at this point your stop would be below that bull bar. And at this point you're thinking the market will get a measured move up. So you probably should keep your original target at 2 times the initial risk, which is around a measured move up. You could use 2 times your actual risk, which would get you out around here. But we have a new projection based upon this being a possible measuring gap, and it's above a projection based on actual risk. So I would use the wider target. Is it time to buy? You're never going to be more than 60% certain, so you can't be paralyzed by the 40% chance of loss, right? And 60% is as good as it gets. So if you see something and you look at it and you say, yeah, the market's probably going to go up, you're a trader, take the trade. Once you think that the market is always in long, you have to get long. You have to buy at least a small position and use the appropriate stop. If the stop is far, then use a small trade a small position. Again, I talk about this in the modules on breakouts and on trading strong trends. Okay. Will the middle third of the day be a channel, a bear channel? Will it be a bull channel, or will it be a trading range? At this point, I don't have a channel drawn in here, right? But it is possible that this is simply a bear trend. We're forming lower highs and lower lows, right? So we are still in a bear trend. Even though we are reversing, right? We are reversing. We are still in a bear trend. So even though the market is probably always in long, it's still a bear trend unless we get above this high. So you could say it's a trading range, it's a bear trend, and it is, and it's an early bull trend, and it is. We need more information to know what ultimately the result will be. Another bull bar, good for the bulls, right? Starting to get consecutive bull bars, always in long. So this is good for the bulls, and there's a pretty good chance, probably better than a 50-50 chance, that we're going to reach our measured move target. 2 more bull bars. So now we have 5 consecutive bull bars, a strong bull spike. It could be a buy vacuum test of the top of the channel. Remember, as long as we stay below the prior lower high, it's still arguably a bear trend. But at this point, I think it's always in long, and I'd rather buy pullbacks. I would not be looking to sell. The market reached 2 times the initial risk, and that created this tail here. Probably a lot of traders took profits at 2 times their risk. We have a strong bull spike, only 1 bear bar in the past 8 or 10 bars or so, and we have several relatively big bull bodies. So I would not exit the entire position. I would just take half off and maybe put a stop below the bottom of the spike here or here and swing the rest. We went sideways into a small wedge bull flag, 3 pushes down, 1 and then bull, and then 2, and then inside bar, and then 3. So I think this is a buy signal, or you could try to instead buy above a bull bar here or above here. For the bears, they saw this bear bar as a failed bull breakout. The bulls saw it as simply a pullback from this bull breakout. As a pullback from the breakout, it's a buy above its high, so you could buy again above here. Small pullback, high 1, pullback from this breakout, we broke to a new high, that's a buy. Buy here, another inside bar, another pullback, that's a buy. A possible final flag reversal, it failed, and so now we have a double bottom, that's another buy. When you're holding a position, you always have to be thinking about taking profits at some point. Okay, now we're above yesterday's high. You can draw a channel here and create a parallel, and we're trying to break out of the top of a bull channel. Most attempts to break out of the top of a bull channel fail, so you have to be thinking that this might be a buy climax. In fact, we have consecutive buy climaxes. Every bull trend bar is a buy climax, right? So we have a climax here, we have a stronger one here, and then here, 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 here. So we're starting to get a series of buy climaxes without much of a correction. At some point, we should get 10 bars, 2 legs sideways to down. So if you bought any of these signals, if you bought all of them, you should be thinking about the possibility of taking profits. Another thing, it's a channel, but look what we have in the channel. First of all, leg 1, if you project up, we're right around a leg 2 move, and we've had a low 1, a low 2, a low 3, and if it goes below here, then we have a low 4. Many channels end with low 4s, so another reason why bulls should be thinking about taking profits. So we have several things going on here that could lead to a transition from a channel phase into a trading range phase. A strong bear breakout bar. So we have a failed breakout above yesterday's high, a failed breakout above the top of the channel, and a low 4 short. I think you could get out below that bar, or you could get out on this bear close, or you could get out below that bear bar. It's not good enough for me to take a short. The channel up is too tight. But when I see a sell signal and I'm long and I'm looking to take profits, I'll get out even if the sell signal is not strong enough for me to go short. And this is what followed. Okay, we had a break below the channel, so a break below the trend line, and then a double top bear flag and a lower high major trend reversal. Okay, the minimum objective after the channel was 2 legs sideways to down. We got 1 leg down, 2 legs down. Also, you'd like to see at about 10 bars in it, and we have about 10 bars. We in fact got a 3rd leg down. Remember, it's not, 2 legs is not necessarily the minimum. Not necessarily the maximum. It's the minimum that you should expect. And sometimes you get 3 legs, sometimes you get an entire trend. And we're now back into the neighborhood of the bottom of the channel. Remember, channels usually evolve into trading ranges. So when the market's down here, you'll say, yeah, it's a trading range. We went up, we went down. But when the market was over here, you were not thinking trading range, you were thinking trend. And at this point, it was a trend. But when you look back, you can say, yes, it was a trend, but it ended up as a bull leg in a trading range. So it was a trend and it was also a trading range, but only in hindsight. That is the end of my module on trading swings in the middle of the day.